Hello, and thank you for joining the 2022 China Investor Symposium. I'm Vanessa Marks from VanEck, and I'm your host for this event. So one of the key reasons we decided to host this event is because we wanted to help the investment community access informed analysis of China, its economy and trends that sort of stepped away from the headlines, stepped away from the media commentary, and the political rhetoric that was dominating conversations. And that's not to say that those discussions aren't important, but we wanted to have an event that really explored the data and examined the investment opportunity so our investors, our clients and advisors can be best informed, because a smart investor is ultimately an informed investor. So, of course, a lot has happened in the last year with regard to the world's second largest economy, but it is prudent to not only look at how the media coverage and public sentiment and whatnot is related and correlates to market performance, but also how they might actually diverge. So today we're bringing you 3 esteemed experts to showcase their analysis and share their insights from the perspective of China in context of global markets, and also examine China's current and potential future policy changes and how they might impact growth. And finally, we're going to look at the future. What will be China's key drivers of growth, and what does all of this mean for investors? So this is a really exciting event, and I'm really glad that you're here to join us for this. So let's kick things off. Actually, no, before we do kick things off, I do want to say one thing. We're actually doing things a little differently than we did last year. This year, we're going to dedicate more time to questions from our audience. So please use the chat function on the left side of your screen if you have any questions that you'd like to ask any of our speakers. And just to make things easier, please just note who you'd like me to direct that question to. We do, as I said, have a lot of time dedicated. We want to answer any and all of your questions, and we're going to try and get through as many of those at the end of the presentation as possible. So I hope you enjoy the presentations, and I hope you find all of this really valuable. So let's kick things off. So our first presenter is, you could say, backed by popular demand, as he was one of our most popular speakers at our China Investor Symposium last year. Gerard Minack has been analysing, forecasting and advising on financial markets for more than 4 decades. His area of expertise is fundamental factors that usually drive investment performance. So we're talking valuation, currency, monetary policy and the economic cycle. He's worked as a senior research and worked in senior research and strategy roles for many of the big banks and advisory services, and started Minack Advisors more than a decade ago. I am delighted to introduce economist and principal of Minack Advisors, Gerard Minack. Gerard, welcome. Can I just double check we've got you off mute there, Gerard?
That's a trap for young players, isn't it? Yes, put me back. Can you hear me now?
Yes, good to go.
Fantastic. Okay, let's get into this. I'm going to look at the really big macro issues for China, and this is going to be high level, focusing more on the economic trends than the investment trends. I will have a couple of slides on investments, but it's going to be a very macro focused thing. A couple of points I'm going to make, which is firstly, I mean, China's trend growth is just inexorably slowing. This isn't necessarily a bearish development, but as I'll discuss, there is an undue reliance on investment, and the real struggle for Chinese policymakers over the last decade has been how to wean themselves off that excess reliance on investment. The ultimate solution is going to have to be consumers spending more. This is the rebalance that they've been trying to achieve, but not very successfully for the last 10, 15 years. Let's start with the absolute basics, though. As we all know, China's been a spectacular macro success over the last 30 years. This compares Chinese GDP relative to growth in the rest of the world. So no surprise to anybody on this call, China has been growing fast. And in fact, if you look at the drivers of global growth, and here I've done a 3-way split of global GDP, just between China, the rest of the emerging economies and the developed economies. All I really want you to note is on the left-hand side of that slide, most of the bars are green. That's the developed economies. That's when they were driving global growth. Over the last 10, 15 years, it's the red and the yellow, so it's emerging markets taking over as the real drivers of growth. Now, let's get to China specifically. Although the size of the Chinese economy has made it very special. In terms of the developmental process that China has been going through, there are other examples historically of the path it's been following. Have a look at this slide, where I'm comparing trend growth, which is just a 5-year moving average, in Japan, Korea, and China, all around the point, which is the purple vertical, where they cross $7,000 per capita GDP. So this is roughly when they start to enter what we consider to be middle income economies. And the fact is, on this measure, China is not very different to what we've already seen in Japan and Korea. Double-digit growth over a run of decades, but once you start to enter that middle income, you do start to see a structural deceleration, and that's exactly what China's been seeing. And that's going to continue. We need to continually recalibrate what we consider to be normal growth in China. Now, the two drivers of growth are how many workers you have and how productive they are. Both these things are likely to slow. This chart just splits potential GDP between productivity and working age population. There is a sharp focus on demographics in China, but what this chart highlights is the bigger issue is going to be how fast does productivity growth slow. Now, although China did have one-child policy, it's not really been the differentiating factor if you look at demographics. This slide is looking at fertility rates, once again, around the point, the purple vertical, where these economies hit $7,000 per capita income. What you can see is that the big drop in Chinese fertility predated the introduction of the one-child policy, and China's current fertility is exactly in line with where fertility was in Korea and Japan at the same stage of their development. I don't think there's going to be much success in turning around China's demographic destiny. And as they say, China's in a race to get rich before it gets old. So far, China hasn't looked any different to those other two economies. Here is where China starts to look different. This chart is showing the share of GDP contributed by investment spending. And the simple point is investment spending has gone higher and stayed higher for longer in China than we saw in those other two comparable Asian countries. The flip side of this exceptionally high investment has been unusually low contribution from consumer spending. This slide shows the share of GDP accounted for by consumer spending. It's remarkably low in China. I mean, for reference, here in Australia, it's closer to 63%. In the US, it's 70%. So this is a very unusual skew to the economy. And this shows three big ways to split the economy. What we saw as the Chinese economy was coming into the GFC around this period I've just highlighted, this was when the then Premier claimed that China's economic growth model was unsustainable, unbalanced, uncoordinated. And the problem was you'd never seen an economy with this lopsided growth mix, with such a heavy reliance on exports and investment and such little reliance on domestic consumers. And this set the framework for what Chinese policymakers have been aiming to achieve ever since, which is to rebalance away from that excess reliance on capex and exports. However, that strategic aim ran into conflict with the objective to manage the growth cycle. And obviously the very first test was the GFC. How did policymakers respond to the GFC? Well, notwithstanding the fact that they wanted to wean themselves off that reliance on capex, what they did was they drove capex aggressively hard in the aftermath of the GFC. This chart shows the credit impulse, so this is the change in lending growth, and investment spending by state-owned enterprises. So you can see this massive surge in capex. So despite the fact that they were trying to reduce the reliance on capex, as soon as they faced a macro speed hump, the first lever they pulled was relying on capex. Now, this was unfortunate in the context because historically, whenever they'd done capex, put in extra capacity, they've been able to sell the resultant product to the rest of the world. And this was when Chinese export growth was booming. On the left-hand side of this slide, you'll see that Chinese export growth was routinely growing at 20 to 30% and dramatically outpacing growth in China's export markets. In other words, they were gaining market share. Unfortunately, post-GFC, we saw a collapse in China's export growth, and that meant the capacity that was put in place via the capex boom in response to the GFC was excess capacity. And you can see what happened if you look at prices in China, particularly prices of goods coming out of factories. They had a nasty bout of outright deflation. Now, this was very tricky, particularly as the principal way they stimulated the economy in the response to the GFC was not direct fiscal stimulus. It was encouraging companies to borrow to invest. So now you have companies that are facing falling selling prices, but over the preceding few years, they'd massively levered up. This chart shows leverage in the Chinese economy. The big yellow blobs is the corporate sector. Trust me, debt and deflation is a nasty macro combination. Now, this really set up the template that we've seen repeatedly used over the last 10 to 12 years. So the big initial surge of leverage and capex was in response to the GFC. When the euro crisis threatened to take down global growth, we saw another surge in credit and investment. When we had the big growth scare in 2016, guess what? We had another big surge in lending and investment. And finally, in response to the pandemic, more debt, more investment spending. And associated with this increasingly was a reliance on not so much production for export, but increasing switching across to the property market. And we've seen strong growth in real estate development, which of course is the latest problem that policymakers have been trying to crack down on. Now, what has this setup meant for investors over the last 10 or 15 years when we've had this so far largely unsuccessful attempt to rebalance, and I would say an undue reliance on investment spending? Well, the first thing to say is it's been a terrible time for equity investors. This chart is just showing change to expected earnings, consensus equity market earnings by region. And of course, the world's come roaring out of the pandemic. And so we're seeing upgrades almost everywhere around the world, except for, and it stands out like the proverbial on the far right, the big downgrades to China. And that reflects this direct policy intervention. You can see what happened in markets over the last 12, 15 months. Broadly speaking, most markets last year saw moderate gains. There were two big exceptions. The US to the upside, outperforming, and China with what was a substantial bear market reflecting these policy measures to try and cap down on capex. This is just a recent example of how the poor allocation of capex has affected investment returns. This slide shows the correlation between earnings growth in China using the MSCI index and nominal GDP growth. And there is clearly a correlation. But there's a trick to the chart, so to speak. The left-hand axis, which is where I'm measuring EPS growth, the 0 there corresponds to 10 on the right-hand axis where I'm measuring GDP growth. In other words, the allocation of capital in China has historically been so poor that they've actually required double-digit nominal GDP growth before they could grow EPS at all. That's a statement to the inefficiency of capital. But the big question, obviously, is why are Chinese policymakers in this jam? Why have they been unable to really reduce the reliance on investment spending to keep growth at politically acceptable levels? Well, the answer, in my view, is not so much that they've had a problem with capex. The really big problem has been the problem with consumer spending and the behaviour of households. And the simple point is households have not been spending enough, or flipped on its head, they've been saving too much. This chart shows that labour income is actually a higher percentage of GDP in China than consumer spending. And if you think, isn't that normal? Well, the answer is no, particularly when you remember that labour income is not the only source of income for the household sector. To go to the other extreme, which is the US, there you've seen this widening gap between consumer spending and labour income, widening for 3 decades. And as I mentioned before, consumer spending at almost 70% of GDP, while in China it's closer to 40%. So the simple problem in China is too much saving. And if you've got saving, it's got to be deployed as investment. So ultimately, the real constraint, the real challenge for policymakers in China is not so much to reduce capex. That will come naturally if they can reduce this household saving rate. Now that begs the question, why has the saving rate increased so much? I think there's a few factors at work. One is demographics, but I think a second powerful factor is the increase in income inequality as China has developed. This chart overlays the household saving rate in China with a measure of inequality, the Gini coefficient. As the Gini coefficient is rising, inequality is rising. And it's in this context you can see one of the elements to the common prosperity thrust by Xi Jinping. If he can reduce inequality, then that could be the magic bullet to get household saving down. But it's a structural challenge. It's not something that you can say, aha, I can factor that into my forecast for the next couple of years. So, in conclusion, Chinese growth is slowing. This is not inherently a bearish thing. This is just the natural ageing of an economy as you move from a fast-moving adolescent to a slower middle-aged person. But China is struggling to rebalance. And although it's perceived as a problem of having too much reliance on capex, ultimately the root of the problem is that that consumer sector is saving too much. Finally, I think investors need to watch the policy in China. I would argue it's the most political influence market out there, not just domestically, but also geopolitical. And that makes it, I think, a fairly difficult investment market, perhaps for the next 12, 18 months, unless you've got a strong view on that politics. With that, Vanessa, I will hand it back to you.
Thank you so much, Gerard. I think I'm going to use that phrase in the future. It was a slower middle-aged person transition to. So Gerard's given us a kind of macro view of China and how China's doing in a global context. We're now going to narrow down our focus even more and look at China's economy in deeper context and specifically the policies that are driving it. And to do this, we are joined by Chief Economist Natalia Gurushina. Natalia joined VanEck in 2013 and focuses on idea generation and economic analysis with particular focus on emerging markets and emerging markets bonds. Natalia, welcome.
Vanessa, thank you very much for the introduction. Good morning, good afternoon, everyone. I would like to focus on 3 issues today. I would like to spend some time talking about China's growth outlook and especially the connection between current challenges in this area and the type of stimulus used by China during the pandemic. We will also talk about potential for additional policy stimulus in China and how it relates to China's economic and political agenda. And I will conclude by going through some of the investment implications. And if you have any additional questions, hopefully we'll cover them in the Q&A session. One point that I always try to make when talking about China's growth prospects is actually very similar to what Gerard mentioned at the beginning of his presentation. Moderating growth is a perfectly normal development as long as China continues to get richer and moves towards a consumption-led growth model. This kind of growth moderation is nothing to be afraid of. And as you can clearly see on the left chart, and again, I'm making the same point as Gerard was making, all China was doing for many years is simply following in the footsteps of its regional peers like Malaysia or South Korea that started this process earlier. Yes, China's growth trajectory looks more scripted and perhaps sometimes too perfect, but directionally there is no difference here. Chart on the right shows one of the reasons for slow growth. Countries with higher per capita income tend to have a higher share of services in GDP, and services usually have lower productivity than manufacturing. In the case of China, the share of services rose by about 14% between 2005 and 2019, as per capita GDP quadrupled over the same period. Growth slowdown that China is experiencing right now, however, is of a different kind. It is related to specific policies, and it causes a lot of concerns. China's near-term growth projections, especially for Q1 and Q2, had been cut massively in the past 6 months. The latest forecast is the dark blue line on the left chart. And the right chart shows that about 1/4, maybe even more, of the consensus survey participants on Bloomberg expect China to grow by less than 5% in real terms this year. This would be meaningfully below the national 5.5% growth target for 2022, which the National People's Congress is likely to set when it convenes in early March. As regards specific policies behind this growth pessimism, there is a lot of focus on the tech crackdown, the zero-COVID policy, supply chain disruptions, and tighter regulations of real estate. And these are all valid reasons. But one thing is often missing from the analysis. I'm talking about a unique feature of China's COVID rescue package, specifically its emphasis on supply-side measures. The two charts on this slide, I think, illustrate this point rather well. The chart on the left shows that the contribution of manufacturing to China's GDP growth skyrocketed early in the pandemic because China, being more of a command economy than your typical emerging or developed market, was able to engage, for example, state-owned enterprises. And this share is still significantly higher than the multi-year pre-COVID average. The contribution of services to growth is recovering, but it's still well below the pre-pandemic average. The chart on the right shows the disproportionate contribution first of investments and then of exports to China's recovery compared to private consumption. Well, the initial effects of the supply-side approach to stimulus were actually quite impressive. China bounced quickly, and it was one of the very few countries to post a positive real GDP growth rate in 2020. China was also able to increase its share in global manufacturing and global exports. You can see it on the left chart. You remember those times a few years back when we were fretting out about China's narrowing current account surplus. Well, the supply-side stimulus kind of seemingly fixed that problem too. And finally, the supply-side stimulus is one of the reasons why China does not have an inflation problem right now, unlike many other countries. And chart on the right shows that. But China's external environment is changing, and these initial tailwinds may become headwinds going forward. The post-pandemic growth bounce in emerging markets is moderating. Developed markets are talking about a faster stimulus withdrawal. And these developments can threaten China's pandemic advances in manufacturing and exports. Now, if the contribution of these drivers fades away, the question is, can domestic consumption pick up the slack? This is a big unknown for this year, and this is where the real estate drama enters the picture. You see, real estate and construction currently account for about 14, maybe even more % of China's GDP, and this is close to the historic highs, as you can see on the left chart. And the chart on the right shows that there is a strong directional link between housing prices and China's consumer confidence. So potential for near-term growth headwinds is clearly here as far as I can tell. Further, if China's consumer confidence remains depressed for much longer, not just in 2022, the question is what happens to China's transition towards a more grown-up, consumption-led growth model, and, for example, such recently announced policy initiatives as common prosperity. I think policy moves announced in recent months show that there is understanding that the real estate sector should be stabilized because the circle of players involved is much wider than just developers, and contagion can potentially affect consumers, financial institutions, investments at large, and trade links with other economies. As you probably know, the government already rolled back some of the regulations in mortgages. State-owned enterprises were given more freedom to buy developers' assets. There were also some blanket policy moves. Back in December, the central bank cut the reserve requirements by 50 basis points, lowered some other rates like real lending rate. In January of this year, the central bank surprised the market participants by cutting the MLF rate by 10 basis points. The loan prime rates were lowered as well. We've already seen some results of this new kind of more dovish policy stance and policy bias. Developer stocks and bonds stabilized. Some, we can even say, rebounded. You can see it on the right chart. Credit conditions for the real estate sector might have bottomed out, and the share of real estate in total credit edged up. This is shown on the left chart. But other trends are still concerning, including real estate. For example, the overall size of bank loans to developers was down in Q4, and this is shown on the left chart. An even more disappointing trend is the lack of recovery in household consumption. China's services PMI continued to trend down in January, ending up just above the contraction expansion border. This is shown on the right chart. Annual retail sales expanded by less than 2% in December, and the activity gauge for small companies moved deeper into contraction zone, actually to the lowest level since the pandemic collapse. So the question a lot of us are asking these days is whether China can dial up policy support. And I think the answer is unequivocal yes. First, China's initial policy response to the pandemic was restrained in size, and it was also largely targeted. We like to call it drip stimulus. There was no wall of liquidity that we saw in developed markets. The chart on the right shows the fiscal portion of China's COVID rescue package. China's share is in red. The size of China's fiscal package was smaller compared to the previous crisis, the global financial crisis of 2008-09, or China's so-called Great Sell-off of 2015. And it was infinitely smaller than the fiscal package, say, in the US. And as you can see, it was entirely reversed in 2021, which is a big difference compared to developed markets in China's own strategy during the global financial crisis. Second, China actually started withdrawing monetary stimulus already in 2020. And the left chart shows that China's interest rates rose on average by 200 basis points between May, June, and December of that year. Third, China's real policy rate is among the highest in the world right now. This is the result, A, of the late 2020 policy normalization, which I just mentioned, and also low inflation pressures due to the supply-side oriented COVID rescue package. This is shown on the right chart. And even if China continues with blanket rate cuts while inflation grinds a little bit higher, we are using the Bloomberg consensus forecast here, the real policy rate will still be among the highest both in emerging and developed markets even 12 months from now. As far as I'm concerned, this is ample policy room. The chart on the left shows that China's reserve requirements for banks are still quite high, despite the recent cuts. Actually, the bulk of these cuts took place well before the COVID, and China's subsequent moves in this space are barely noticeable in comparison. Now, as regards the central bank's recent communications, I think they sounded very dovish. January's press conference referred to more proactive and front-loaded monetary policy stance, even mentioning things like getting ahead of the curve. There was a pledge to fully use the policy toolkit in order to avoid a credit collapse and a signal that there is room for further cuts in reserve requirements if necessary. So to quickly recap what we've just talked about in policy space. First, there was no wall of liquidity in China. Second, China started to withdraw stimulus early. And third, China has very high real policy rates while central bank communications are dovish. Well, there is also factor number 4. And China has room for more policy support on the fiscal side because the 2021 budget was massively underutilized. Chart on the top shows various fiscal categories. I'm not going to go through all of them. In 2021 relative to what was budgeted. You can see the big difference between these numbers. Green, what was budgeted, blue what actually happened. The chart on the bottom shows China's general government revenue relative to spending over the past 8 years. And the fact that China's revenue rose a lot in 2021 was not surprising. We saw similar trends in many other emerging markets. The reason is that domestic activity, revenue projections, things like that were often stronger than very cautious projections that were made in the middle of pandemic. What makes China different is that this windfall revenue was barely touched. The bottom line is that the Chinese government is cash rich and can easily afford to prop up growth by this particular channel, especially given there were signals from the Central Economic Work Conference to accelerate fiscal spending, especially on infrastructure, to lower taxes, fees. And importantly, the government can do it without additional bond issuance, which is, again, a problem or potential problem for many other emerging markets. The question is whether China wants to do it and how much difference this would make. I think the chart in front of you is very telling. China's leverage declined a lot in 2021 by 8 percentage points of GDP. This is a big number. And an even partial reversal, say due to lower mortgage rates, can take time. And by the way, the 5-year loan prime rate that leads mortgage rates was cut only by 5 basis points. That's not too much. Another observation is that the current round of easing is likely to be selective, even in real estate, where large and healthy developers, perhaps state-owned companies, might end up being the main beneficiaries. Take, for example, much discussed easing of escrow accounts requirements. As you can imagine, there will be few incentives for authorities to ease requirements for high-risk names. Why? Because authorities want to minimize the risk of unfinished buildings, and this is really simple as that. This selectivity would be in line with China's more grown-up approach to domestic issues, especially structural ones. China wants to move up the value-added chain, and it now focuses on the quality of growth as much as quantity. One example of this approach can be seen on the left chart that shows the ongoing sequential decline in China's shadow financing. This is despite growth headwinds and real estate developers' problems. The chart on the right shows another policy area that is becoming increasingly important, ESG. China aims to eventually become a global leader in this area, but the starting point is really bad. The chart shows how China ranks versus the rest of the world in the environmental field. We created this chart using the World Bank's environmental database. The blue dotted line is the world average. Everything that is inside the dotted line is better than the world average, and everything outside the dotted line is worse than the world average. The units are standard deviation. I'm not so sure that I have to make any additional comments about this chart. So China has a lot of work to do here. In addition to paying more attention to the quality of growth, ideology is becoming increasingly important as well. And perhaps the key lesson from 2021 is that the market failed to appreciate China's willingness to tolerate the downside and move farther and more abruptly on structural front and in order to meet its ideological objectives. Perhaps China's tech and real estate crackdown should not come as a surprise for those EM watchers who've been through a certain Yukos episode in Russia about 15 years ago. What happened at that time is President Putin decided to pretty much kill one of the best-run private oil companies in Russia because its chairman had certain political ambitions. So this strong ideological dimension, ideological vector in China, it's a new reality, so we'd better get used to it. One area where we might see more changes this year is the exchange rate. A more competitive renminbi can boost exports, which can be handy if domestic consumption continues to lag behind. And as you can see on the chart in front of you, after several years of moving in step with its regional peers, the renminbi diverged big time in 2021. Strengthening by about 3% against the dollar, whereas the rest of the region weakened by 5%. So what's going on here? Historically, the renminbi had been affected both by capital flows and interest rate differentials with the US. However, capital inflows, which we define here as current account, direct investments, and portfolio inflows, clearly dominated in 2021, whereas interest rate differentials took a back seat. China's inclusion in global bond indices, I think, played a big part in it. So the question is, shall we expect this to continue in 2022? Well, let's look at capital flows first. The chart below, in front of you, yes, I think it's in front of you, shows the history of inflows into emerging markets with China and without China. What this chart tells us is that pretty much all foreign capital that wanted to leave emerging markets outside of China, India, and South Korea had already done so. And this is a big difference compared to the multiple crises before, European crisis 2012, global financial crisis, but also the US Federal Reserve's hiking cycle of 04-06. And the main takeaway for me is that China is among very few major emerging economies still exposed to potential sizable capital outflows if the market gets spooked by, I don't know, the policy tightening cycle in developed markets or something specific happening in China. So even if the capital flows factor remains the dominant driver for the renminbi in 2022, there is a non-negligible risk that it will be pushing the renminbi lower, weaker, allowing it to close the valuation gap with the interest rate differentials. So with all that in mind, when VanEck investment teams sit down and talk about things, what do they think about market implications? We have several investment strategies related to emerging markets. We have passive strategies. We have an active equity fund in the US. This strategy is led by David Semple. We have an active fixed income strategy led by Eric Fine. And as regards fixed income active strategy, we do like China property. First, policy has been engaged. Second, a lot of the bonds have collapsed in price. We started accumulating this position since November, and I'm so far happy with the results. Being very selective is the keyword, naturally. We are not too eager to have CGB exposure despite ongoing policy easing. First, the yield differential between CGBs and US Treasuries are narrowing. The chart in front of you shows that the 10-year differential is now smaller than 100 basis points. And as a result, valuations now look far less compelling. And second, we see, as I just mentioned, a risk of CNY weakness in the coming months. And by the way, if this risk were to materialize, we have to be more cautious and selective on EM local currency exposure in general. But at the same time, the chart on capital inflows that I just showed to you suggests that if there is another market scare in China, the risk of a major negative spillover into the rest of EM is probably quite low. So summing up, China's current growth headwinds have origins both in much publicized specific policies like zero COVID, tech crackdown, and restrict real estate regulations, but also in China's initial response to the pandemic that was geared towards supply-side measures. Second, China does have additional policy space, maybe more than most emerging market peers or developed markets, but its usage will be determined by policy objectives that go beyond simple GDP growth rate. And third, China's real estate developers look attractive now, but a greater risk of the renminbi weakness makes us reluctant to invest in CGBs and being more selective in EM local debt space. Thank you very much for listening, and back to you, Vanessa.
Thank you so much, Natalia. I've actually had one question come through specific to what you've just presented, so I might just throw you one question now, if that's okay. So the question is, Natalia, are you saying that China is moving towards fiscal and monetary stimulus in 2022 after tightening previously, whereas the rest of the world is moving to monetary and fiscal tightening in 2022, so going in different directions? If so, would China return to being the global growth engine?
Well, China is definitely moving towards easing on both fronts, on the fiscal side and on the monetary policy side. But the point that I would like to make is we refer to China's initial stimulus as drip stimulus. And I think the same drip stimulus is going to continue. It might include some blanket measures, like some of the further cuts in reserve requirements, some perhaps further cuts in the medium-term lending facility rate or the loan prime rates, but they're going to be very small. So I think the emphasis is on taking care of specific issues rather than flooding the system with cash and opening credits. This is just not going to happen. End of story. China is not moving in that direction. Yes, I think there is a huge discrepancy between what China is doing and what other emerging markets are doing, or what developed markets are doing for that matter. The question about whether China will become the growth engine, China is a growth engine. The question is whether we are talking China contributing less than the current expectation to overall growth or more. And frankly, I think that's still a big unknown for us right now. I think I would probably say that the risks are a little bit to the downside. But, if China grows close to 5%, that's a big growth driver.
Great. Thank you, Natalia. And just a reminder to everyone tuning in, definitely send through your questions. We are going to have a segment at the end to answer as many of those questions as possible, and you can do so via that chat function on the left side of your screen. And also, just to let you know, I've had a few people ask, this presentation is being recorded, and everyone that has registered will receive a link to a on-demand version of this webinar this time tomorrow, so you can go back and look at everyone's presentations and all the data that's being presented as well. So again, thank you to Natalia. And now we have our final presenter today. So we're going to firmly focus our lens on future China and the sectors and opportunities for growth and what all of this means for investors. So I'm delighted to introduce Carlos Diez, who is CEO and founder of MarketGrader, known as the world's smartest stock and ETF research platform, responsible for the China New Economy Index. So Carlos is one of the world's leading authorities on China's new economy sectors. So Carlos, I'm very delighted to have you here. Please let us know what you'd like to tell us today.
And I'll talk about the new economy. So I think if there are two common themes that I take away from the prior two presenters are that China is in the process of rebalancing its economy or attempting to do so. And it needs to focus on a consumer-driven model. So we actually agree with that. And I think that has been the case for some time, which is why we have been focusing for about a decade in what we call China's new economy. So we're essentially saying China is a significant growth engine. We think it will continue to be that, but I think you need to invest selectively, and you do so through a new economy lens. So I'll explain what we mean by that, and I'll also get into some of the things that are happening today. So our presentation is called From Theory to Practice. So, how do we take this opportunity? We still see it as a very big opportunity, and how do we turn it into something that is easy for investors to access. So I'll start with, has China lost the plot? I will admit that for a moment I thought about using that as the title of the presentation, but then I thought new economy sounded better. So it's fair to ask that question. We've asked that question ourselves. We get that question from clients all the time, and it's not it's not an unusual question to ask after the remarkable year we had last year. So it seemed like last year, every other week, China was going after a different type of economy, different type of, or industry, I should say, different type of company or set of companies. So investors are right to ask, are they going after the private sector itself? And is China kind of shooting itself in the foot and actually killing the dynamism of its economy? And from an investor perspective, what should an investor do? Either you own Chinese securities or are thinking about buying Chinese securities. So in our view, no, China has not lost the plot, but I think it's important to understand the government's motivations and the economic backdrop to help investors understand what kind of playbook is required to be successful in China. So that's what I'll attempt to do today. So we have what we call now the New Economy 2.0 playbook. And it basically has three different parts. The first one is what we call follow the policies. The second one is ride the macroeconomic wave. And the third one is be selective. So I'm going to do something slightly different from what I I always do. I always really like to focus, and that is our strength on company selection, the quality of the companies that we're looking to own. That hasn't changed, but I think China is pretty unique in that policy matters a lot. So, and I start by focusing on the latest 5-year plan. It's the 14th of the 5-year plans. We think it's unique, and we think that it comes at a very pivotal time in China. So we actually call it the New Economy Plan. I know it sounds kind of coincidental or sort of self-serving, but actually if you read through the plan, we've gone through it in great detail, you actually see what the government is saying in terms of the structural reform that they want to implement. And they talk about innovation as being a fundamental driving force. And they talk about something, as it sounds simple, but, the good life as the fundamental growth. I know it sounds trite, but actually, this is actually what's guiding policy in China. And the importance of 5-year plans is that China attaches or creates very specific policies based on their 5-year plan. So it's one of the few countries in the world that actually has an economic blueprint, and they come out and publish it and say, this is what we're going to do for the next 5 years. And actually, they pursue policies to do that. And if you actually go back and look at, say, the last 40 years, which is where the greatest growth in China has come, have they made policy errors? Absolutely. Are they, paying the consequences of some of those? Yes, they are. But most importantly, they have kind of always tried to drive the economic engine through that lens. So what I have on the screen now is a kind of like a timeline for context. And why do I have this timeline? Symbolism is very important in China. And 2021 was a critical year for 2 reasons. Number one, they celebrated what they call the first centennial, so essentially the 100-year anniversary of the founding of the Communist Party. So this is also a time that allowed them to come out and say, we actually achieved a lot of the goals that we had in the last few decades, and more specifically, like I have on the screen, what they call the establishment of a well-off society in an all-around way. I actually cannot disagree with that. Are there imbalances? Yes, there are, but what China has done has been tremendous. So point number 2, it's also important because it kind of marks the beginning of a new phase of growth, or more specifically, structural reform that should lead to higher quality growth. And so this is where the current 5-year plan is so important, or why we think it's so important. And a quote from there, it says, we're embarking on the journey to build China into a modernized socialist country. And again, a lot of these verbiage sounds sort of trite, but they are coming out and saying, this is how we view our economy. These are the challenges that we have. This is how we're going to tackle them. So I have 2 shaded areas above the timeline. One that talks about, and this is obviously our kind of take on it, the new economy outline, meaning they're outlining the blueprint for how they're going to support the new economy model. Again, consumer services based, and I'll get into that shortly. And a clear goal for them is to be the largest economy in the world by 2035. And they call it, realization of a socialist modernization. And then further out, there's the second centennial, again, symbolic important, which is the 100-year anniversary of the founding of the People's Republic of China. So we are at a time where China is kind of looking ahead, moving forward based on this ongoing rebalance. So I'm not going to bore everyone with a lot of the details of the 5-year plan, but we took the most important part, which are the parts that concern us as investors, which are the economic development parts. So the plan has 19 parts, 7 of which are economic development, purely economic development in our view. So it's the lion's share of the plan, and that's the stuff that we focus on. So again, I'm not going to dive into the weeds here, but we built something that we call the MarketGrader cheat sheet to understand what's actually in the plan. So we took out 2 key themes that stand out throughout the entire plan, and then key strategies within the economic component of that that we think are important for investors to keep in mind. So the 2 key themes are balanced growth and adequate development. So, and under the product development cycles column, that's actually MarketGrader's verbiage, where we compare what the themes and the strategies are today versus what they were in the past. And in the past, China was just focused on growing, and they were focused on high single-digit, low double-digit GDP growth rates, and pretty much developing it at any cost. I know that's a bit of an exaggeration, but that's kind of how it seems at times, especially in terms of gross capital formation, fixed investment, and so forth. And on the right-hand side, we have our view on whether these themes and these strategies are either positive, neutral, or negative for purposes of the new economy theme. So as you see, we think they're large positive. There's some that are neutral because they don't really apply to what we're thinking about. Lastly, on the policy front, you have probably heard a number of times about a term called dual circulation. And this is an important translation of a part that is, or a component that is critical to the 5-year plan. So this is actually broken down into two parts. The first one is the domestic component. Actually, the government calls it the domestic grade circulation. What does that mean? Loosely translated, is basically we're going to build a vast consumer market, a healthy consumer market, a vibrant consumer market, and then that's going to be the driver of our growth. And how are they going to do that? They're going to focus on building up Chinese brands. They get into very clear specifics about the kind of industries that they want to see grow and kind of compete on par with Western brands. And they talk about cosmetics and clothing, textiles, electronics, so very specific themes. And they're talking about quality overall. So this is the build out of that domestic part of the economy. And then the international component of dual circulation is essentially promote, once we build this, or as we build this massive domestic market, we want to turn China into a trade powerhouse. Obviously, China is a significant source of exports to the rest of the world. But the Chinese understand that the kind of exports that have brought them to where they are today are not the kind of exports that are going to take them to where they want to be by 2035. So what does this mean? Basically, improve the quality of exports. I make a note at the bottom of the slide to talk about something that has been a very hard lesson for the Chinese within the last few years, which is basically once the U.S. put a hard ban on certain key technology exports to China, more specifically semiconductor equipment, and everything that leads to the growth of those sectors. They basically said, we're not going to be dependent on U.S. technology or foreign technology much longer, or as much as we can help it. It's going to take a long time for them to make that transition to localization. But the point here is, from an investor's perspective, China is devoted to focusing on what they call hard technologies, foundational sciences and technologies that will allow them to become sort of self-sufficient in some of these core technologies and eventually become also a source of them to the rest of the world. So that's what dual circulation means. We think it has significant implications from an investment perspective. My second point is, riding the macro wave. So I'm not going to delve into it too much. We just had two economic experts speak about that. So I'm not going to pretend that I know too much more about that. But this is important to put the opportunity into context, especially when you come out of a year like 2021. We look at China, and it accounted for about 16% of the world's GDP in 2019, the last, pre-COVID year. But in the decade leading to 2019, it accounted for more than a third of global growth. So, it is a growth engine. We think it will continue to be a growth engine. One of the earlier speakers alluded to kind of the composition of China's GDP based on, this is production factors. So they break it down into primary, secondary, and tertiary industries, where primary was agriculture, which is clearly no longer a very big component of China's economy. Secondary industry is manufacturing and construction. That had been, up until about a decade or so ago, kind of the biggest component of GDP. And now the third industry, which is essentially services and consumption, is kind of the biggest component. But it's still, I like to point out that it's about 54% of GDP when you combine services and consumption. It's still well behind the roughly 82% for the US. So we think there's a lot of catch-up growth in getting to that level. And we do think China's going to get there, but it's going to be a challenge. So we also look at GDP growth from an expenditure perspective. And here you can break it down into into three different parts. One is final consumption, another one is gross capital formation, and then the third one is net exports. I think here it's important to point out net exports because to the average observer of China, you would think that China is this factory of the world sort of story. So they must be highly dependent on exports to power economic growth, in addition to all this investment in infrastructure, real estate, and so forth, which is where gross capital formation comes in. The reality is that for over a decade now, the lion's share of China's GDP growth has been final consumption expenditure. So they already are a consumer-based economy, actually. And I took some numbers, and if you look at, again, 2019, the last sort of normal year before we had the pandemic-based sort of dislocation, China grew at 5.9% that year, I think. And if you subtract exports, net export from that, you get to about 5.2%. So it's not that big a drag on, in simplistic terms. If you were just to do that, it's not that big a drag on their economic growth. However, if you subtract final consumption expenditure from total GDP growth, then GDP growth would have been only somewhere around 2.5% that year. So that changes the picture significantly for China. So I agree that they need to continue to focus on the consumer within their economy, and they know it really well. So, and lastly, as China tries to catch up to the rest of the world in more advanced technologies and making that a big component of their economy, they have been, relatively quickly catching up in an important metric, which is spending on research and development as a percent of GDP. They're getting close to the OECD average, but still have a little bit of ways to go to catch up to the US and Japan, two of the examples I have of some of the countries that have some of those, the highest numbers in that metric. So that's kind of the macro point. And now the third one is where MarketGrader really cuts its teeth, where we like to focus, which is being selective. So being selective, in our view in China, is comprised of two parts. So one is obviously the new economy. So we call, when you break down China sectors into traditional classifications, for us, it's consumer discretionary, consumer staples, healthcare and technology, and then all the others are the so-called old economy sectors. So what we did is MarketGrader rates about 5,500 Chinese domiciled companies, including the entire offshore market. That includes Hong Kong, everything traded in the US, and then the entire Asia market, which is about 2,800 to 2,900 companies. So what we did is we took a snapshot of the same set of companies at the end of 2019, right before the pandemic hit the economy, and then at the end of 2021, just the year just ended, and we excluded all companies that are below 500 million US in market cap. So we ended up with 2,796 companies, and we asked ourselves, let's see if our new economy versus old economy thesis played out by seeing how, in the aggregate, these companies did or fared through the pandemic in terms of sales growth, operating income, assets, debt, and free cash flow. So as you can see, the new economy companies actually did better, marginally in terms of sales, 33% growth versus 24%. In terms of operating income, just about the same. Actually, operating income in the aggregate was down 3% for new economy, 1% for old economy. And then in terms of free cash flow, new economy companies did much better. By the way, the pie chart shows you that in terms of aggregate market cap, old economy companies still represent 61% of the entire domestic market in China. So we believe that that share of the pie is going to continue to shrink for the old economy and grow for the new economy, but we continue to think that the pie overall will continue to grow. So here comes the MarketGrader part of the story. So we don't just take new economy companies versus old economy. We actually qualify or grade or rate these companies, which is what we do regularly. And so we have a scoring system from 0 to 100 based on company fundamentals, and I'll get to that in a moment. And so we took all the companies that have a score greater than 50 in the MarketGrader scale. Those were all buy or hold rating. And then we looked at all the highly scoring companies in new economy and old economy, and then did the same analysis that I described before. And here, the new economy really shines through. So you see that sales growth was about 3 times as high as the old economy companies. operating income was 2.5 times higher, and free cash flow was almost 3 times as high. If we rank all the sectors in China based on operating income growth through the pandemic, you see that the 4 new economy sectors are among the top 5 in the group. So that part of the story has played out like we expect. Obviously, performance doesn't necessarily correlate directly to this, and we understand that performance was a challenge last year. So as I mentioned before, how do we look at these companies? And this is true in China, the United States, Europe, or anywhere where we rate companies. MarketGrader covers about 40,000 companies using this, what we call GARP plus quality methodology. So we have 24 fundamental metrics that we break down into 4 categories. So you see growth and value at the top of the chart. That's the GARP part of the equation. We're looking for growth companies or companies that are growing nicely, but that you can buy at a reasonable price. And then in the bottom 2 quadrants, we have profitability and cash flow. So we aggregate all these indicators and construct or calculate a numerical score between 0 and 100, which determines the rating. Anything above 60 is rated buy. The example I have on the screen is one of the semiconductor manufacturers that are part of our current new economy index. So, and then how do we bring this all together in the new economy? This is kind of a quick depiction of our process. All our analysis is based on financial data, basically company financial statements and share prices. We do our GARP analysis, our metrics, we calculate the market score, isolate the new economy sectors, apply size and liquidity filters, and then we build kind of 4 sub-indexes, or we select the best 30 companies in each one of the 4 sectors, and then we aggregate those into what we call a super index, or the new economy index, which are essentially, from our view, the best 120 names in China with a new economy from this GARP perspective that we have. We equally weigh the portfolio, and this is something that we repeat twice a year to make sure that we have just the highest rated companies in the portfolio or in the index all the time. So now let me bring it all back to the beginning, where I talk about the importance of policy and the importance of the economy, or the macro economy. So I'll start with the economy. What does the current portfolio, the current index look like in terms of the makeup of the industries based on a traditional classification? So 17% food and beverage companies, 13% apparel, consumer electronics, internet services, then diagnostics and drug delivery devices, semiconductor manufacturing, software. So again, it's consumer-based, service-based industries, technology, especially hard technologies, and obviously medical devices and other areas of the healthcare space. And then we did something unique this time. We said, let's take out those themes that are prevalent in the economic portions of the 5-year plan and come up with actual, verbatim the themes that the government is saying we want to support, and assign these categories to the different companies and different industries in our new economy index. So that's what we have represented in this chart. So we assign one of these themes where relevant to each one of the companies. And so we end up with the top 3 being, as you see towards the bottom of the chart, the dark blue section, which is about 40%, is what the government calls the rise of indigenous Chinese brands. So this is an important part of the new economy story, for the consumer to be incentivized to buy more Chinese apparel, what have you. They need to have quality that's comparable or better than Western brands. We think China is moving in that direction. The second biggest contributor is which is in the gray section of the bar towards the middle of the chart. Traditional Chinese medicine and medical device companies, 2 items that are front and center in the 5-year plan, or the economic components of them. And then the third one, in terms of contribution to the index, it's toward the top of the chart, which are in the purple shade, which are essentially the technology parts of the index. So the government focuses on what they call advancements in the field. So basic research, again, hard sciences, innovation-focused enterprises, electronic components, electronic equipment, 5G, artificial intelligence, quantum computing, semiconductors. So they want China to focus a lot of their technology efforts in, again, what they call the hard technologies. And I think that explains a lot of what they've done in terms of what people refer to as a tech crackdown last year, which really focused more on the consumer internet companies. And I'll touch on that shortly. So I have a couple of examples of actual companies that we own or that the index has. This is one of them. To give you an idea, some flavor for what our views on this new economy theme are. This is a maker of golf apparel and casual sportswear. Probably unknown to most consumers outside of China, but it's the official partner of China's national golf team, and it has over 900 stores in China. It's growing at a very nice clip, has been a member of the index since 2018. And why is it a new economy fit? Because it fits, the quality is now comparable to Western brands. It fits with the theme of the rise of indigenous brands in China. It's what we call a safe haven industry because we don't expect a lot of government interventions from a regulatory perspective on these parts of the economy. And then it also plays into the national pride that Chinese have in shopping for their own brands, as opposed to just buying another Adidas or Nike or Polo, golf outfit, for example. And then the other example I have are two of the semiconductor companies that we have in the index. And here the fit is obvious. Again, like I said before, the government is focused on kind of delinking the supply chain, dependent on some Western technologies for their own for the growth of their own semiconductor industry. So these are two examples of the companies that we own in that space, or that the index owns in that space. And so to bring it all together, I'll conclude with just 3 points. So number one, we do think the current 5-year plan, which sets the stage for China's forward-looking structural reforms, is very closely aligned to the new economy theme, to the new economy industries. The government sees a window of opportunity while the economy is still growing and doing fairly well. Again, short-term headwinds notwithstanding, to concentrate on deepening structural reforms. And by the way, from our perspective, for what it's worth, we think the biggest headwind right now in China, especially for the consumer, is the government's zero COVID policy. So, a lot of consumers have been hunkered down in China. I know a lot of you in Australia are very familiar with that. But it has limited the amount of travel people do, the amount of going out they do. So that has really definitely affected economic growth in the last couple of years. But my second point is, we do not think that what has happened in the last 12 months or so has been an outright attack on the private sector. We just think Beijing wants to curtail practices that run counter to its goal of sustainable and socially responsible growth. And again, it all comes back to the consumer economy, healthy consumer market, and innovation and technology. And then lastly, we see this kind of bifurcation, especially within technology or the new economy theme of what we call safe haven industries from others. And so here, some of the areas that we think are less prone to government interventions are semiconductors, science-based technology. What does that mean? Robotics, anything that has to do with aerospace, medical technology, which is mentioned prominently in the 5-year plan, consumer brands. And so what's out of favor? Consumer internet, obviously the two big names, Alibaba and Tencent. There's others. And in favor, hard technology, again, some of the names that I just mentioned before. And so lastly, this trend favors A shares, or companies listed in China, more so over offshore listings. And why is that? Because a lot of the large, prominent consumer internet names tend to be listed either in the US or in the US and Hong Kong. Some of them do have domestic listings in China, but our index has mostly some of the other names that I referred to before. So I think that's also an important thing for investors to keep in mind, favoring, at least in the near term, the A shares market over the offshore listings. And so with that, I come to the end of my presentation. I'll turn it back to you, Vanessa.
Thank you so much, Carlos. That was fantastic. So now we have time for a Q&A session with you, the audience. So please send through any and all questions you have for any of our speakers via the chat function on the left side of your screen. And if you could let me know which speaker you'd like me to direct the question, that would be fantastic. fantastic. So we've had a few questions come through in regards to how to access the new economy and if we have an ETF that tracks the new economy index, which Carlos has gone through today. The answer is yes. Our ETF has the ticker CNEW, CNEW, as the China New Economy ETF. So VanEck actually has a deep history of investing in China. We've been doing this for more than 30 years. VanEck is one of the few fund managers worldwide who actually has an RQE license. This is a really important license because it allows the fund manager and allows us to access China A shares. These are the companies that are listed on China's two main exchanges. If your fund manager doesn't have that, then they can't actually access those companies. So we have two ETFs, the CNU, which is what I mentioned before, and we also have the FTSE A50 ETF as well, our China FTSE A50 ETF, and that has the ticker CETF, or CETF as I call it. And you can find out information about both of those at the bottom of your screen, or you can just send us a message and we're happy to send out more information to you directly as well. So let's kick it off with, I'm going to ask a question to all of our speakers. We've had, I don't think we can sort of mention China without mentioning the geopolitics and some of the rising tensions that are happening across the media and we're hearing about. I'm interested to hear from each of the speakers, and these questions have come through from the audience as well. What do you think this is going, how do you think that the geopolitics is going to impact China growth in the short and the medium term? So Natalia, can I throw to you first?
Yes, I think in the near term, in the very near term, the impact is likely to be negligible. In the longer term, let me make a question or suggestion. So we focus a lot on China's growth model as a consumption-led growth model. In a sense, looking at China through kind of a Western perspective, right? Let me throw something else at you. How about looking at China more from the Soviet Union perspective? From the Soviet Union experience. And what I'm trying to say here is that there were certain geopolitical tensions back then, and the response was to increase the role of the so-called military-industrial complex in the economy. So as a result, for many years, the Soviet Union was able to post reasonable growth rates. I think if you look at the historical estimates, like 4-6% a year, but was it benefiting people? I don't think so. So in a sense, the simple answer to me longer term could be yes. I mean, China can post very high growth rates by building several extra air carriers a year, but doesn't mean that this growth will necessarily trickle through to the population. That's basically what I've been trying to perhaps define as a more grown-up growth model. That's a big question. So for me, it's not necessarily whether geopolitical tensions can lower growth rates, is that geopolitical tensions can lead to a completely different growth model in China, the one that perhaps we are not even thinking about right now.
Great, thanks, Natalia. Gerard, can I throw to you to have your thoughts on this question?
I think there's a deep dichotomy. I think if we just have geopolitical tensions without a hot war, then this is just throwing some sand into the gears of the global economy. It's going to create frictions that didn't exist before, and that will have costs on both sides of the geopolitical divide. And what you're effectively seeing now, for example, is parts of the global IT industry carving into a Chinese-centric hemisphere and a US-centric hemisphere, and that's going to reduce efficiency and increase costs. It's a different league if it goes hot. If we saw aggressive sanctions, let's say China moves on Taiwan, then all bets are off, and it becomes potentially quite a significant factor, quite destructive. And that's even before we consider the absolute worst case scenarios. So for me, base case, fingers crossed, it's tensions and that's it. That becomes something that slowly damps efficiency. If we see something worse than that, then as I say, it could become a really material impact on investors.
Thanks, Gerard. Carlos, can I throw to you?
Yeah, so I'll make 3 points. And the first two are that I agree with what Natalia and Gerard say. So in terms of Natalia making the comparison to the Soviet Union, I think that is right on. I think if there is one country that is an expert in understanding what happened to the Soviet Union and what led to its dissolution, it's China. So China has been very focused on not seeing that experience repeat itself with their country. So what does that mean? They're very focused on economic growth. They are very focused on not so much these highly centralized economy, although that seems kind of counterintuitive in China, but on empowering their consumer class. And so I think they're heading in the right direction there. So to Gerard's point, I also do not think there's going to be a hot war. I cannot predict anything like that. I think tensions will continue simply because there's just too clear differences of streams of thought, political thought globally. And so my third point is the following. I think the decoupling that we've been hearing about between China and the rest of the world actually will continue. I don't think that means complete economic disengagement. I think China's going to continue to import a lot of things from the rest of the world. It's going to continue to export things to the rest of the world. But I think, a good example is semiconductors. I think they are going to, it's going to take a long time, a lot of investment domestically, but I think they're going to find a way to become more self-reliant when it comes to these core science-based technologies, semiconductors being one of them. So I think that decoupling will continue.
Thanks, Carlos. And if I could stay with you for just a second, what would you say to investors who feel quite a lot of trepidation about investing in China, who have a sense of fear and are wary about investing there and being able to sort of trust China?
I think it's natural. I feel it myself. I've been bullish in China for a long time. I like a lot of the big economic story. I like a lot of the positive things that China has going for it. So I think it's a natural question to ask yourself as an American and as an American investor. I ask myself sometimes that in relation to the U.S. So you see, there's a lot of negatives surrounding China. Yes, we know about a lot of the issues they have, economic imbalances and real estate sector. But if we look at the U.S. And again, this is not to do an apples to apples comparison. The U.S. we just crossed $30 trillion in debt. Part of which are liabilities to our social security system in the future. That doesn't really bode well for the U.S. We have significant political issues. We have a lot of education or issues with our education system. All these things are going to throw sand in the gears of our economic growth over time. So does that mean that I'm bearish on the U.S.? No, I'm bullish, optimistic on the U.S. Despite some of these challenges. So my view on China is the same. I am optimistic on China despite some of these challenges.
Great, thank you. Can we look at the tech sector in China for a moment, Carlos? So we've had a few questions, and this often comes up with the topic of investing in China. A lot of the likes of Alibaba and Tencent. Can you talk to tech in terms of China A shares versus sort of tech companies that are listed elsewhere? So the question is talking about so Alibaba and Tencent were so aggressive, they've gone to really dropped in value. Can you kind of talk to that and if there's got to be a recovery expected versus sort of what's happening with China A shares tech?
Yeah, so I'll start by saying that we do cover both companies, Tencent and Alibaba. I personally like them both a lot. Have always liked them, continue to like them. Like them more now that they're a lot cheaper than they were, say, 2 years ago. Having said that, there's series of challenges that require a different lens for you to understand why the government has done the things that they've done. So, and I don't think these are nonsensical. I think you look at Alibaba, for example, and it all goes back to when they were planning on doing the Ant Financial IPO. Ant Financial became this massive engine to generate microloans to the consumer in China. But the company was not reserving enough as a financial institution to cover these. So they were actually offloading a lot of the risk to the financial system and just acting as an intermediary and creating, what the government thought was potential systemic risks down the road. So they just said, wait a second, if you're going to behave as a financial institution, then you should be regulated as a financial institution. So that to me makes kind of sense. So that was one part of where the Alibaba thing started to kind of not fall apart, but have some issues. With Tencent and some of the other internet companies, I think some of the concerns the government has had are valid, and we have those concerns with some of our large internet consumer companies here in the States, and we have ongoing arguments, political arguments all the time. If there's one thing where both parties in our country can agree on is that we need to regulate the big internet companies because they're monopolistic, they're too powerful, they impinge on people's personal privacy, what have you. So this is not germane to China. It's just that China tackles these things very differently than, say, the US would. So to summarize, I do like the companies. I think they're tremendous companies. I think they will be around and do well. Also, fair disclosure, we have other Chinese indexes that include offshore companies and that own these two companies. So I do like them. I would be a little bit cautious, though, going forward.
Great, thank you. And if I could ask you one more question about a different sector. So looking at the consumer discretionary sector and consumer spending generally. So we have a question around sort of to get your thoughts on the people sort of reading in the newspapers and seeing news about sort of a crackdown from China on sort of celebrity culture and gaming and other sort of entertainment sort of companies and whatnot. How is that going to impact growth? How is that going to impact the overall economy as well?
Yeah, so kind of in the same vein as my prior answer, I think there's two sides to that coin. And by the way, I'll start by saying that I'm not an apologist for China. I find fault with a lot of things that China does, with a lot of the way they do certain things. So I just try to separate the political situation from the investment opportunity and just look at the positives on the investment side. So having said that, so think about the two sides of that coin. So I'll mention two examples coming from these companies. So one of the concerns that the government raised with Tencent is that, Chinese kids and young people were spending too much time gaming, which is time that they could be spending doing other things, learning, practicing a sport, what have you. They think, too much of this is unhealthy, too little of that is also unhealthy, so we need to be more balanced. I actually cannot argue with that. I think we have the same issue here in the United States. We have a massive issue with our public education system, and on top of that, it's very easy for kids to be distracted with things like that. So, is that an economic issue? Well, it could be an issue for Tencent and some of the gaming companies, by the way, some of which we have in the new economy index. But these are private enterprises, profit-seeking enterprises that find a way around it within the rule of law. And then the other point I'll make is, also Tencent and Alibaba, they are part of the so-called gig economy. So there's others, for example, that are some of these delivery platforms, like food delivery platforms. So when someone delivers food throughout China or anywhere, the government is concerned about the protections for that worker, for that gig worker, from making sure that they have fair pay and what have you. So it's hard to argue with that. So more than a crackdown on saying, hey, you cannot do this, we don't want you to grow more powerful, and so on and so forth. We want to make sure that the growth is balanced and that the consumer is protected, children are protected, and so forth. So again, two sides to one coin. We try to look at both sides.
Great, thank you. Natalia, I have a question for you. In general, what were your thoughts or comments around comparing the growth trajectory and investment environment in China with other EM markets, for example, Southeast Asia?
Well, the growth trajectory, I think it's pretty much leading in the same direction at least in the near term. We are talking about moderating growth, which again, it's partly normal after a big bounce that many economists experienced immediately after the pandemic as a result of stimulus. But I think what makes China different from the rest of emerging markets, including regional peers, is that China can do significantly more about this moderating growth. And I really try to give you as many examples as my presentation as possible. It can do more both on the monetary policy side and the fiscal side. Whereas other emerging markets already spent a lot of their so-called silver bullets, especially on the fiscal side. They're actually concerned about something else. They're trying to reduce the amount of fiscal stimulus. Another difference is if you look at inflation dynamics in emerging markets versus China, the specific type of stimulus in China is partly responsible for the fact that China doesn't have inflation. As a result, China have more policy space. So that's what places China kind of in a different position compared to emerging markets, where pretty much both sets of countries are having the same facing the same growth issues. So China is in a different policy cycle, so to say. And another point that I would say makes China different, but perhaps a little bit more exposed to some negative investor sentiment right now compared to other emerging markets, is that issue about capital flows, because capital already left a lot of markets going into the Fed hiking cycle, which it wanted to leave. And that's, I'm not talking about only about LATAM or emerging Europe. The same happened in parts of Asia as well. So China is particularly exposed in terms of potential sizable capital outflows. So I think when we're thinking about investment opportunities in China versus emerging markets, even though some of the growth challenges are the same, but where China is on the policy cycle and where China is in the inflow cycle make a difference.
Thanks, Natalia. So I've got 2 more questions for you.
Mm-hmm.
The first one is, why was there a sharp drop in shadow lending over the past 3 years? And the second part is, has the government given any indication it intends to increase fiscal spending in the near term?
Well, let me just say one thing first about shadow lending, because it often has very negative connotations. Shadow lending, I mean, the proper definition of shadow lending is its activity that effectively takes place outside of the regulated banking system. So in this regard, we have shadow lending in other parts of the world, both in emerging markets and the developed markets. So I think this emphasis on regulated is really key word. And I think it should be considered as part of this whole kind of new approach towards greater regulation. Oh, and by the way, sorry, let me tell you that these shadow activities, engagement in trusted loans, trust loans, and things like that was a very big part of the real estate developers' activities, which actually generated a lot of issues. So this focus on more regulation, on making sure that you have a properly functioning private sector, but a private sector that acts according to the official and state goals, objectives, and targets. And this implies more regulation. And as a result, I mean, what we are seeing right now, and so in a sense, it should not perhaps come as a surprise, that with more emphasis on stability, emphasis on more regulation comes as a natural consequence. And answering to the second question, it's not just indications about additional fiscal spending. The Central Economic Work Conference pretty much said it in the plain language. What I would like to say is that there is this pretty sizable carryover from the 2021 budget, which can be used this year. So fiscal expansion, additional fiscal expansion probably will be limited, maybe like 1.5 percentage points of GDP, and not just coming from more spending, but also from reducing some taxes and fees. So perhaps from having a little bit less revenue collection. And when we, if you go through these official documents and see what the emphasis on spending, we see the words infrastructure investments. So what I like to emphasize is not just infrastructure investments in a sense that these are roads that lead nowhere. Infrastructure in a wider sense includes schools, hospitals, and things like that. So I think that's where China's kind of targeted fiscal stimulus is going to be.
Thanks, Natalia. Gerard, so we've had a question come through. So the Economist recently reported a decline in life expectancy in the US and the UK for the first time ever. Can you share what's happening in China and what it looks like for that country?
Well, I mean, the decline in those other countries is obviously a reflection of the pandemic, and China's zero tolerance has meant that China's life expectancies continue to rise. I don't think we've got official figures yet that I've seen for 2021. So it just shows the divergence in their pandemic policies.
Great, thank you, Gerard. We've had a question come through regarding just policies in general. In 2021, what do you think were the most effective policies that China enacted, or the most ineffective?
Policies with respect to growth or with respect to COVID? I mean, they've been in a funny situation. I mean, China obviously is the origin for the pandemic, cracked down hard and had its initial downdraft in economic growth in calendar 2020. And therefore it was the first out of that recession. So a lot of the difference between Chinese growth and growth outside China over the last 2 years is partly a reflection of different policies, but it's just partly a reflection of sequencing. They went down first, they were out first. I guess what's tricky now, and we've had a taste of it here in Australia obviously, is how do you maintain a zero tolerance approach to pandemic when you've got a virus, a variant as contagious as Omicron? Clearly China is continuing with zero tolerance through the Winter Olympics, but it's looking increasingly untenable in places like Hong Kong. So I think that's going to be the real challenge for them over the next few months.
Thanks, Gerard. Gerard, does the digital yuan, a central bank digital currency, have any impact on the Chinese economy, e.g. via the central bank's ability to control monetary policy?
Well, in theory it could, but I'd highlight that the central bank in China has had more policy levers to pull than your average central bank in developed economies. We've seen this repeatedly over the last few years where they've effectively instructed the state-owned banks to lend, to state-owned enterprises to invest. So unlike in developed economies where the cliche is monetary policy is like pushing on a string, in China authorities had tools that could make monetary policy far more effective. So a digital currency might assist in that control, but it's not a prerequisite really for monetary policy to work.
Thank you very much, Gerard. So we have time for one final question, and I'm just going to throw back to you, Carlos. We just had a specific question regarding the China New Economy Index. Carlos, can you remind us again of the process of adding or removing companies from that index and how often that happens?
So that happens twice a year. We do it in June and December. So essentially, the process that I described in the presentation where we grade the companies actually happens on a daily basis. Obviously, companies' financials don't change on a daily basis. When they report earnings, we get the latest report and we incorporate it into the model. So we re-rate all the companies as the financial reports come in. So come the rebalance, we basically look at all the universe, the new economy universe. We apply the filters that we described, and then we reselect the index. So we select again the 4 sub-indexes, and we end up with 120 companies. So that is kind of the process that we run twice a year, again, June and December.
Great, thank you, Carlos, and thank you for your presentation today, Carlos, and the same to you, Natalia and Gerard. Really, it's been a pleasure having you as part of the symposium. It's been fantastic hearing all your insights and data, so thank you very much.
Thank you.
And thank you to everyone that's tuned in today. I recognise that we didn't get through quite as many questions as we would have liked, but don't worry, for all the questions we didn't get through to today, we will come back to you directly after the webinar. And just a reminder again, this webinar is being recorded and we will send you a link to that recording at this time tomorrow. So we hope you enjoyed this. We hope you found a lot of value out of this. As you can see on your console, there are a lot of links there should you like to find out more information about our ETFs or if you have any other questions for our speakers. So thank you again for joining us, and we hope you take care.